Hi, good morning, everyone. Welcome to our webinar on navigating the ETS2 transition period that we're in at this moment in time. I see we have a lot of participants in already, and some of them are joining us at this moment in time, so they might join us in the coming minutes. My name is Bart Rest, and I'm here together with Tim Atkinson of CFP Energy and Emma Nokewas of E&C Consultants. And throughout the session today, we will give you some insight on the EU ETS2 regulation that is in place at this moment in time, that is still unfolding and that is still being implemented by some countries and some member states. After that, Tim will dive into the details of the ETS2 carbon market, give us an insight on the reality that we see in the market on a daily basis now that trading started to kick off on the ice. And after that, Emma will give us more details of the impact that we see of ETS2 on your energy supply contracts, on your energy billing, and how to navigate that in this transition period in the run-up to the 2027 launch of ETS2. At the end, I will wrap up with some proposed mitigation strategy, and we will leave some room for questions in the Q&A. You can write your questions in the Q&A tab, which we then will handle at the end of the session. Any unanswered questions might be answered then via email later on, if that's still necessary. So let's get started with the ETS2 regulation. What we see in reality is that the energy policy is actually adapting to the energy transition that is taking place. We come from a period where you classically had one electricity contract, one gas contract, and that reality is changing into a set of contracts, offsite PPAs for power. You have some residual power that you procure, sometimes some balancing power. And also for natural gas, we see some changes there. Natural gas contracts, steam contracts being in place, green gas being procured. So the energy transition is really kicking in. It's happening both for electricity and natural gas. And we see that energy policy is adapting to this and following up on this new reality. It's very clear and has been clear in the past years with the ETS1 that some of you might be familiar with, where we saw that this is a tool that's being used to reduce greenhouse gas emissions throughout time. We also saw that on the European level, the European Commission came with a carbon strategy for industrial carbon management. They are at this moment in time working on a 2040 greenhouse gas emission goal that is not published yet, that is not final yet, but we know that this is upcoming. We see at the same time that the Renewable Energy Directive 3 is setting stricter targets to reduce greenhouse gas emissions with the ultimate goal of having a 55% greenhouse gas reduction by 2030 compared to the 1990 levels. Latest forecasts and indications show that we're getting close to that we're almost there. But we see that those energy policy tools are necessary to reach that goal. Most recent ones are the introduction of the carbon border adjustment mechanism that helped to create a level playing field on greenhouse gas emissions also outside Europe, and tighter goals for hydrogen, where they want to increase the share of renewable fuels of non-biological origin that are on the basis of hydrogen production, and they want to increase that to around 42% by 2030. So as you can see, there is a whole set of energy policy, energy changes that is adapting to this new reality. And emission trading is one of this. The introduction of the ETS2 is actually part of a bigger global movement where we see that emission trading schemes are appearing throughout the globe. Some of them have been in place for years already. Some of them are implemented at this moment in time or under development at this moment in time. In general, we see around 68 emission trading schemes in operation on a global level at this moment in time, covering around 17% of global greenhouse gas emissions. To put that in context, Europe is a bit of a front runner there. You see a lot of the European maps being colored. If ETS2 is implemented, we will have around 75% of greenhouse gas emissions in Europe covered under either ETS1 or ETS2. So after ETS2 will be implemented, the majority of greenhouse gases will be covered in Europe under an emission trading scheme. If we have a look at the size of ETS2, then we can see that it's not something to be ignored. You can see on this chart that's coming from VATE that we have a historical emission of around 2,000 million tons under ETS1. Those emissions have been decreasing throughout the past years, so we can see the success of ETS1 in driving down emissions that are covered under this trading scheme. But still around 1,300, 1,250 million tons are now going to be covered under ETS2. And so the size of ETS2 is really significant. What we see is, however, that looking at those last 15 years, that those emissions didn't come down that much as what we have seen throughout ETS1. And that is obviously the goal of this new scheme that's going to be introduced, is to repeat the success story of ETS1 into the emissions that will now fall under ETS2. Now, what is ahead of us and what has been done already? Let's go back to last year. We saw that in June 2024, there was a deadline for European member states to implement the ETS2 directive into their national legislation. But we had a lot of bad pupils in the class. I think at that moment in time, only 2 countries were in time. Majority was late. European Commission had to go after them to say, hey, let's make sure that this implementation is done. And step by step, most countries are on the right path now by implementing this regulation into their national legislation. Then the second step was in January of this year, where first data gathering happened. That data gathering was on 2024 consumption and 2024 emissions. Some of participants here might have been contacted by their natural gas supplier with the question to hand in some volumes that would fall under ETS2. And that's exactly the underlying driver of this exercise that we saw with a lot of natural gas suppliers throughout Europe. Then more recently, in May of this year, we saw some first price trading happening on ICE. Tim will give some insight on that later on in the session. And then in July, we will start to see similar things appearing on the AAX. And so first exchange trades happening at this moment in time. At this time, no options yet. Then looking into the future, what we can see there is that as of next year, the Social Climate Fund will kick in. The underlying idea of this is that it will compensate for part of the cost increase so that member states can give certain reductions to people who fall under ETS2. Similar to, for example, the indirect carbon leakage measures that we see under ETS1. Looking further into the future, 2027, this is the original start date. As of that moment, auctions will begin. The price cap, maybe we should put it between brackets because it's not really a price cap, it's more of a market stability reserve, will start to kick in with 45 euro per ton as well. Although potentially this original start date can be delayed into 2028. There is a potential to revise the start date if gas or oil prices are high throughout 2026. This is something that the European Commission will track in the first 6 months of the year to see if this condition is met, is triggered, and whether or not the start date will be 2027 or 2028. And then we will have a first phase running at least until 2031, where any decision on price cap removals could be taken at a later stage, maybe a blending of ETS2 into ETS1, but all of that is still far, far into the future. When we compare ETS1 and ETS2, we see some similarities. Both have that same minus 55% greenhouse gas goal by 2030. Both work with this market stability reserve, although the triggers of both systems are a bit different, but the underlying idea is that both have market stability reserve to balance out markets in case of increases that are too high or too quick. But we also see quite some differences between the two. On the one hand, you see ETS1, which has a very liquid functioning market Whereas for ETS2, we don't see any liquidity or any real functioning market at this moment in time. ETS1 covers the heavy industry, the aviation, and more recently also the maritime sector, whereas ETS2 covers heating, transport, and the smaller industry that currently doesn't fall under ETS1. So the scope of the two schemes are different. ETS1 works with free allocation. Although this free allocation is phased out throughout time, there is definitely in the beginning of the scheme, there was a lot of free allocation being handed out. No such thing will happen under ETS2. And that is a very important one because we see a lot of industrial consumers that in the beginning of ETS1 were well supplied with free allocation. Some of them even over allocated, let's say, so that there was not a real and direct need to procure allowances under ETS1. That will be different under ETS2 since there is no free allocation. There will be a direct and immediate need to start procuring allowances. Although we see another difference there. This time, the regulated entity is not the emitter, not the industrial user or the household or the person driving the car, but it's the fuel supplier. It's the natural gas supplier. It's the fuel importer that is the regulated entity. The reality, however, is that they will probably pass through this cost. And that's the reality that we see at this moment in time, is that they're preparing to pass through those costs to the end consumer, to the emitter, although the emitter is not the regulated entity. What it regulates is slightly different. ETS2 mostly focusing on CO2, whereas the scope of ETS1 is a bit broader. And there is also a more practical operational difference, whereas the allowance deadline to hand in your allowances for the emissions of the previous year under ETS1 is at the end of September. For ETS2, it's at the end of May. So you have a bit of a different timeline there. Now, main question is, how tough are those goals under ETS2? So we had a look at the volumes that are covered on this. It's fairly similar to ETS1. We saw the success story of ETS1. And here we can see the goal that is set ahead of us. We looked into the last 15 years of emissions under ETS2. They hardly moved, they hardly came down. Also, zooming in on the last 10 years, you see on the left-hand side of the graph that they hardly came down. So we have a 4% decrease on the last 10 years of emissions under ETS2, whereas on the right-hand side, you can see the cap and the trajectory for the coming years for ETS2. And there you see that by 2037, we have a goal of a reduction of 70%. Compare that to the historical performance of 4%, and it's very clear that what lays ahead of us is very ambitious and will ask quite some changes, behavioral changes from the people falling under ETS2. So the goal is much harder than anything we have achieved until now for this scope of emissions. There are some measures to soften that goal. What you can see, as said, there is no free allocation, there is auctions only. You can see on the graph on the right-hand side that they will do some front loading. So what they basically said is we will soften the start of the scheme. Yes, we know the goal is ambition, but we'll soften the start. And we will do that by front loading from 3 years into the first 2 years. So they will take allowances from 2029, 2030, and 2031 and front load those into 27 and 28 to make sure that enough allowances are available in those first 2 years to basically give the market a kick start and to make sure that the supply-demand balance is good and that prices don't immediately go through the roof. After that, they will continue with the normal path of emission goal, which is tighter year after year, and that's being done by a linear reduction factor. So kick off with some front loading, extra allowances into 27, 28, but we will also have year after year less allowances in the market, a tighter emission level with a linear reduction factor of 5.10% in the first year, and then after that some 5.38% later on. So this gives us a bit of a timeline on what to expect going forward for that period as of 2027. And a second measure to lower the impact is the so-called carbon price cap, but it's in reality more of a market stability reserve where They say, well, we want to avoid that prices go through the roof. So the moment prices go over certain price triggers, in the first period 2027 to 29, that first price trigger is 45 euro per ton, but adjusted for inflation. If prices go over that for 2 consecutive months, then we will release some extra allowances into the market. In this case, it will be 20 million ton, which is around 1.5% of the 2027 cap. So they will bring extra allowances into the market, change the supply demand dynamic. But as you can see, a 1.5% extra allowances into the market is not that much. Moreover, we have to say that the measures that are being taken after that, so period 2027-28, to bring more allowances into the market, 50 million ton or 150 million ton, are much stricter. They are linked to the auction price being 1.5, 2, or 3 times higher than the previous 6 months, and that for 3 consecutive months. What we have learned and seen under ETS1 is that those triggers are very hard to be met. It's very hard to have an auction price that is 1.5, 2, or 3 times higher than the previous 6 months. So I'll hand over to Tim to give some insight on the working of the carbon market under ETS2 at this moment in time.
Great, many thanks, Bart, and yeah, thanks for that introduction. Delighted to be joining this webinar, so thanks to E&C for the invitation. Just to give a little bit of background about CFP Energy, we're an environmental and energy risk management firm specializing in carbon compliance. It's something as a firm we've been involved in since the start of the ETS back in 2005, a market I've been involved in as well for coming up for 20 years now. So seen many different sort of prices and strategies in that market, and certainly I think looking ahead, the challenge really for those affected by ETS2 is going to be one where carbon markets are at the forefront of policy. As Bart said, it's something that ETS1 has grappled with, has learnt from, and I think certainly the regulators on ETS2 are hopefully learning some of the lessons of ETS1. But again, it does mean that this carbon market, whereas ETS1 started at a lowly €5, if I remember rightly, ETS2 is certainly expected to start at higher carbon prices. But where are we at? Very early stages in the market. As you may be aware, a market is really driven by transparency on exchange. I mean, you can have trades on an OTC basis called over the counter, but a market really starts in earnest once the exchange pick up the contract, and then you start to see liquidity and you start to see different actors get involved, whether they be suppliers affected by the scheme, whether they be banks looking to trade it, whether they be traders themselves sort of looking at positions in the market, and an exchange brings that liquidity. So we've seen the two main carbon exchanges launch contracts or due to launch contracts. So ICE has been trading since May. EX is due to list their contract in July. So yeah, still very early days. Skip on to the next slide, please, Bart. This is kind of where we're at the moment. As you can see there, this is the ICE contract, which started in May. The volume on the right-hand side is in lots. So one lot is 1,000 allowances. And this is for their December 28 contract. So agreeing the price now for forward or future delivery in December 2028. ICE took the view that they were going to err on the side of caution. Obviously, the scheme is likely to start in 2027, as Bart mentioned, but until we get absolute clarity, and I think what we'll see then is that ICE will start to list 2027 contracts. I think EX has gone down the route of the assumption that the scheme will start in 2027, so their contracts are going to be listed right from the start at December 2027. But as it is, this is the main benchmark that we have now. Sorry, Bart, just skip back a bit. I was just going to mention a couple of things about this. You can see there was 5 lots traded on the start of the contract, so that's 5,000. But then we've seen no trade since. So the pricing you'll see there is based on the settlement calculation that ICE employ for the market. Broadly in line with EUA1 prices at the moment. I think for want of anything else, that's really setting the benchmark. there is some sense of correlation. But the key thing is, as you can see there, when you see the bid offer spread, so the market, this was as of Monday when I put this presentation together, was 80 bid, 95 offered. Not surprisingly, more interest on the bid side, so 9 lots there, 1 lot offered on the offer side. I think the sell side of this market is going to be the challenging one. Where do you price allowances? Where do you sell allowances, given we don't have an underlying spot market until auction starts in 2027? So that spread will reduce, but it's a bit of a problem when you're trying to, if you compare that to ETS1 market, the spread in that market is sometimes between 1 and 5 cents, so much tighter in the volumes available. So again, low liquidity at the moment, wide bid offer spread, but we're starting to see the emergence of that market. At least there's some price history there for those companies who want to explore it. Next slide, thanks, man. Great. And I guess the view is, really when you're looking at this, why would you start to think about hedging your requirements now when the scheme doesn't start for another year and a half at the earliest? And that's really a view on price. And we see this in ETS1. We see at the moment, prices around 70 in ETS1 versus future price forecasts over 100 by 2027, 28. So the view is look, do you take advantage of current favorable prices versus that future price forecast? And the expectations are, I mean, as Bart mentioned, there is this front loading, as it's called, this sort of extra 30% allowances that's going to be released into the market into 2027 just to help the market start. That's typically something we've seen in every market. The UK ETS, when it started in 2021, did the same. It's just to provide that added hedging buffer, if you like, and liquidity of allowances into the market. So, in the short term, that might be a little bit, soften prices, as you can see there from the VATE analysis. On the right hand side there, you can see expectations of prices going to start around the 50 mark, 55, not surprisingly taking sort of guidance from the market stability reserve mechanisms and where additional allowances would come into the market as a price point, but then very quickly rising over that period towards the back end of the scheme, or certainly the first phase in 2030, up over 100. Some view they might be, Bloomberg there looking at 150, VATE, looking closer to 200 by 2031. So the expectation is that very ambitious cap that Bart said is going to really squeeze prices going forward. Little bit hard to kind of see the interaction of how those market stability reserves are going to come in. Will the additional volume that comes in be significant enough to actually cap those prices? Again, it's all very well having a reserve and having the ability to add more allowances, but the pace at which they come in is, if that's not up to kind of the liquidity in the market, then they tend not to have the impact they're intended to. So the way that those mechanisms actually function in practice will be key to look forward to. Next slide. Great, thanks. And yeah, so limited things to say about the market at the moment. I think, if anything, we want to learn the lessons from ETS1. As I said, volatility in that market, what drives it in although the ETS2 is slightly different in the way it's on suppliers who provide those fuels, as well as some smaller industrial companies who are not covered by the ETS1 under that 20 megawatt threshold. Whereas the ETS1 is very much on end consumers, operators, the scope 1 emissions. So slightly different in the dynamics, but again, I think ETS2, when it really gets going in earnest, probably into next year, if I'm honest, of where we'll see sort of trading increase, we'll pick up the same kind of drivers as possibly ETS1. And you can see here, this is price history over the last sort of 18 months. It's been very volatile, anywhere between a low of sort of 55 and a high up about 85. So we see a number of drivers. There's fundamental drivers, i.e., is the wind blowing? Is it coal-fired generation versus gas-fired generation? What's the outlook for industry across Europe? How's free allocation changing? So there's fundamental drivers come into play. But certainly something we've seen in the EU carbon market, and if you just skip to the next slide, please, Bart, that has had an impact is this speculator influence. Basically, traders looking to may take positions as a commodity. Carbon's a commodity and allowance is a commodity on a trade on exchange, like oil, like gas, like cocoa bean futures, whatever you want to see. It's a commoditized product now. We typically see 20 to 30 million allowances trade on exchange every day, and all of that is not obviously compliant, but it's this real step change in the last 2 years where traders, particularly commodity traders, are looking at a basket of energy and carbon commodities and taking positions. And we can see here, this is plotting what we call the commitment of traders data. Every week, the exchanges have to publish data on investors and other firms who hold positions on exchange. And it's quite closely followed in the market now to the fact that it's now a price point, really, and a driver in terms of everyone will look at what is the overall position of those investment funds in terms of the market. And you can see here in white how those positions have shifted from a short position, i.e. they think the market's going to go lower, to a long position, i.e. they think the market's going to go higher. And there was this big shift over Christmas and early into the new year where we saw those investor positions really rally. And not surprisingly, that correlates with the rally up over £80 in terms of the blue line, which is the EU allowance price. So you can see how the two are very correlated depending on those positions that investors are taking. So it'll be interesting to see if they take the same view when it comes to ETS2. I don't think they're going to be very active in the market at the moment because they want to see liquidity. Any investor trading this wants to know if they take a position, they can get out of it if they need to. And the big kind of sell-off in investor positions there through to April was very much a risk-off time, i.e. that Trump was tweeting every day about the next tariff he was going to apply, and global macroeconomic markets got very nervous. And typically in those sort of scenarios, you'll see investors actually try and reduce their positions, reduce their exposure. So we saw this big sell-off in those net long positions throughout that month, and not surprisingly, the prices fell with it as investors tried to get out of those long positions, sell their allowance holdings. So again, but they need liquidity to do that. As I say, in the EUA market, 20 to 30 million allowances trade a day, they can do that. Until we get liquidity in the ETS2 market, it's hard to see them really getting involved. So I think certainly for the first early year of the scheme, it's going to be very much suppliers, traders, in terms of fuel traders, looking to use this market to manage their positions. Next slide, please, Bart. And just in terms of that position, just a few thoughts here on what companies who are affected by ETS2 could be thinking about, lessons from ETS1 again. As I say, the obligation's slightly different. It falls on the suppliers rather than the end operators. Obviously, that's been the focus of the scheme, is fuels to kind of building and transport. There is other parts of the scheme where member states can opt in other sectors, whether they be small industry, other fuel users. So it's worth keeping a close eye on what your own member state is doing in terms of those additional opt-in sectors, because it might well be that some of the actual end users, industrials and manufacturing companies will do that. But again, it's a challenging requirement. You've got to forecast those allowances. You've got to track the market. You've got to manage those rising compliance costs. Do you look at the forecast? How do you manage that? So certainly for ETS1, our conversations with clients are all about what's your requirement for this year? What's your procurement plan? What's your purchasing strategy? What's your budget available to buy allowances? Can you buy now against 2026 requirements? 2027 requirements either, because if you look at what is a favorable price. So it's all these discussions, and it's very important when you're developing a strategy to look at number two there and number three. Number two, certainly, and I think this would be my focus if I were looking at ETS2 and those clients that we've had conversations about with, and that's where they're focused, understand those future requirements, get to grips with how you're going to manage this. Is it going to be a pass-through cost? And I know Emma will talk a little bit more about this in the next section, but is it going to be, how are you going to treat it? Is it something you're going to build into your price and hedge those allowance requirements, or are you just simply going to pass through that cost to the client when you deliver that fuel? Do clients, are you speaking to your customers about whether they want to lock in the price of ETS2 allowances at this time? So that's understanding the future requirements, and then keeping up to date with carbon prices. Very much in ETS1, as the market has become more volatile, we've seen an increasing interest from our clients to get better sort of understanding of the market. Previously, they just come to the market once a year and buy their requirements when they need them. But now with the volatility, is there opportune times to buy? They need to track the market. So we're providing those insights, that those price points, what are favorable prices, how does that fit into the budget? And as I say, route to market access, it's worth exploring how you can access, although liquidity in the market needs to improve probably before we can quote anything remotely sort of decent in terms of a spread, but we will start to see that. So again, it's planning for that next phase as we move into the end of this year, early next year, where we probably start to see some hedging activity increase. Next slide, please, Bart. In terms of the contracts, sorry. What can you be looking at the moment? Obviously, there's only forward trades, i.e. you fix the price now for a date in the future. Again, something we do very commonly and increasingly in ETS1. So, for ETS2 allowances, there is the exchange. You can access that exchange, so you can start to explore those hedging opportunities if you want. The spot market will obviously only begin once ETS2 auctions start in 2027, once we have that physical registry up and running, because they tend to be much shorter settlement times, and it can end up being simpler. And then other structured products that we work on ETS1, options, accumulators, which is basically an actively managed risk management strategy that achieves discounts on current EUA prices. And then a straight pass through, the average price index, a product that effectively tracks an average of the EUA settlement price over a period. So again, we've seen quite a bit of that in the shipping sector, where it's a pass-through cost, and where ship owners want to simply say to charterers, this is the average price over a period. Again, it's very transparent. It's not trying to beat the market, it's just tracking the market. So those products are quite attractive where companies are looking to pass through that cost. But again, a range of structures will develop in this market, like we've seen in ETS1. At the moment, we're limited to those forward trades if you did want to hedge. I think that's all really from my perspective I wanted to say on the market. Hopefully that's been useful. Be more than happy to have any conversations, help understand our expertise and our experience from ETS1 and how we're translating that into ETS2. So I'll hand back to Bart, but thanks very much.
Thanks a lot, Tim, for giving us that insight on where we are with ETS2 at this moment in time, and making some of the lessons learned that we can have for and what we have seen in ETS1. I would like to hand over to Emma, who can give us some insight on the impact of your energy contract and energy bill. So what we see on a daily basis happening in an energy procurement, and that is already related to ETS2. Emma, floor is yours.
Good morning. I'm Emma Nokevas. I'm a E&C consultant. I specialize in French and Belgian markets, but I also do a lot of regulatory topics and international coordination. So as Bart said, we'll dive into the actual impact for you specifically, and I encourage everyone to use the chat and ask questions that we can answer at the end. So first off, to start is you have to review what the impact is in specific countries. So what we see is there's a varying degree of future adoption for ETS2 depending on the country. So this map shows you where there's already an existing CO2 or gas tax that is going to be replaced, where it's going to stay in place because it's either the same scope or the same price, and the country is asking for an exemption or not, where there's actually already an excise tax, or where it's not fully known yet. So what we can see specifically is if we look at Austria and Germany, they already have existing taxes or CO2 taxes, so gas or CO2 taxes that are being replaced fully, and we'll go into detail of Germany in a minute. If you look at Ireland and Finland, they already have a tax in place that is the same price or higher than ETS2. So they ask for derogation until 2030. So this can be done if the country already has a tax, the price is equal or higher, and they ask the derogation to the European Commission that then has to agree that there can be an exemption until 2030. Some countries like Czech Republic and Poland have an existing tax and they could ask for derogation, but it hasn't been done yet. So it's not because there's already a scheme in place that it means there will be a derogation. Some countries are still deciding on this. And the last category sort of is the tax exists, but it's not high enough. So it will either be added, ETS2 cost will be added to the existing price, or it will just completely replace it. This is the case, for example, in Slovenia. And finally, we have the example of Sweden, which I think is the only one in that aspect that already has a tax, but it will add ETS2 on top, so it will really be additional costs. So this is key for you to know where to look for and what to look for. If we look at the second slide, which is more focused on the scope, so this is the same type of map where you can see is the scope of the existing carbon or gas market the same one as ETS2. So usually that means there's already a market in place. In Austria, Finland, and Germany, the scope that is applied in their existing carbon market is actually broader than ETS 1 and 2, which means there's actually more sectors that are covered. And even in the ones that have a broader scope, there can be some exemptions. So if we look, for example, at Italy, same in Finland and Austria, again, we can see some exemptions, for example, for rail transport. So the message behind this is ETS2 is happening. There's still a lot of uncertainty, but you need to plan and check in which countries you have activities and how is it going to impact the business. Because if the tax is already existing and it's not being replaced and it's the same scope, the impact will be more limited. If your activities are mainly based in a country where there is no exemption possible, or the scope of the existing market is smaller than ETS2, or maybe even there's actually no market whatsoever, then you need to look into it. If we dive into the Germany example, so more specifically, because as I mentioned, in Germany, there's already a national emission trading system, which will actually be replaced by ETS2. So in Germany, the national emission trading system was functioning on the basis of a fixed price per year, which increases over time between 2021 and 2025. The cost for 1 ton of CO2 varied from 25 euro per ton CO2 in 2021 to normally this year 55 euro per ton CO2 in 2025. The second phase of that system was that the pricing is supposed to be reviewed by the government this year, and then eventually in 2026 they will move towards an auction-based mechanism with a minimum price level at 55 euro per ton CO2, which is what we see now, and a maximum price level of 65 euro per ton CO2. And eventually it will be phased out and replaced by ETS2 completely. So initially it was supposed to just move towards the auction mechanism, and now it's actually changing. In terms of scope, the German scope is actually broader than ETS2. So if you look at the sort of bottom right side, we see the ETS1 with industry, power plants, aviation, etc. And then on the right-hand side, the national trading scheme, which is a combination now of ETS2 with heat generation, for example, and transport, but it also has waste incineration, which was added in 2024. So you can see that some schemes are actually more complete than ETS2, and they can combine with each other to be more efficient. But so in Germany, again, the national scheme will be fully replaced. Looking at the price impact now, so what you're seeing here is on the top layer, the euro per megawatt hour price, and the bottom layer, the actual cost. So focusing more on the upper part of the slide, we compare COVID gas price scenarios versus the energy crisis price scenarios. What we want to show here is different scenarios of ETS prices. So in navy blue, you have the commodity, in gray, distribution cost, and in green, other taxes. So other taxes would include ETS2 costs. What we see is, if we look at the COVID gas price scenario, where gas prices, depending on the country, but here specifically for Germany, were around 15 euro per megawatt hour, the cost of ETS seems quite significant, because then you're just adding an extra layer, which is from a low ETS cost, almost the same value as what you're already paying for the commodity. So you're essentially doubling the cost of your energy just with non-commodity. And with a high ETS cost, is twice the price of the commodity. So this seems quite significant when we have lower prices. But if you look on the sort of mirror on the right-hand side, with energy crisis price scenario, the share that taxes and ETS2 tax represents seems much more marginal, because it's either the same size or lower if we look at current or low ETS. So depending on in which stage the market is situated, the impact of ETS2 will seem more marginal. However, it is still very important, because if we're around 20 to 25 euro per megawatt hour, regardless of if your commodity is high, it will continue increasing the price. This is just for Germany, and this is already an existing tax, so the impact is lower. But if we look at Belgium specifically, where ETS2 is a new tax, currently there's an excise, but not a proper carbon tax like there is for ETS2, you can see that the impact is even more significant, especially when we see that distribution costs and transport costs are much lower than in Germany. So again, looking at COVID price scenario versus energy crisis price scenario, you can see that the share represented by taxes, so in green, seems much more significant when commodity prices are lower. However, it's not to be neglected. And again, if we look at the energy price crisis scenario, it just means that the total cost increases again. In this case, we can see an average price around 75 euro per megawatt hour for the energy crisis price scenario for the total, and then versus COVID, where we're below or equal to 60. So an additional 25 euro per megawatt hour in any case has a high impact on the budget, and which is what Tim was touching upon, that we need to plan it. It's an uncertainty, but you can have a bit more control over it. So concretely, different countries, varying degree of adoption, different way of impacting the budget, because either it was already planned and being replaced, or it's completely new. What we have been seeing now for the last, I'd say, 9 months, almost a year, is suppliers have started to now include a specific clause in contracts. So many of you may have already signed a contract for 27, 8, 9, maybe 2030, depending on your strategy, and you might have stumbled upon these clauses. So the first example is a Belgian one, and the second one is French. So in this case, either the supplier passes it through, and it just indicates that at the time of signing the contract, the price is not yet known, and the method that will be used to invoice the client is not certain. So they will agree at a later stage, but that the cost will be passed through and mentioned separately. So clearly on your invoice, there will be an additional line. And in the second case, it's the sort of same thing, as in the supplier is not able to determine the cost as of today, but they will pass it through again to avoid having to include a risk premium on top. These are just two examples, but we see it in many countries. So it can be a pass-through, fixed price, hedging, etc. But this specific clause now is something to look out for, because it means that it becomes a criteria in your selection process. Because do you want a supplier that will include a vague clause where you can discuss at a later stage, but that means uncertainty until the last minute? Do you want to have a very, very specific clause with very little flexibility, or nothing at all? In the best of case, what we recommend is that you have a clause that allows you to have more visibility in general, and it should always be included. This is a discussion to bring up with your supplier, because it's a competitive advantage for them. The more visibility, the better. If we move just to the next slide, so this is what I was mentioning with sort of the three approaches. The impact will be different whether it's a passive clause, fixed, or a hedgeable position. So with sort of the passive, it's passed through, so there's no control over the cost. The supplier is doing the hedging themselves, and they will pass through the cost. In this specific scenario, it's difficult to compare suppliers because we don't know exactly what the price that they will offer will be, and you will find out on the invoice or at a later stage. With a fixed approach, it's a fixed price that's agreed upon in the contract. We've seen this appearing now in Dutch contracts, for example, in the Netherlands. You have no control over the price in this scenario, but you have a possibility to choose the supplier with the best price. So, for example, we would include this in quotation analysis and compare which supplier has the best fixed price so that you're fully in control of the cost. Of course, to be checked if the price for ETS2 is not lower with a supplier because the risk premium on the commodity price is higher. So again, this is really something that has to be taken into account. And then the final approach would be it's a hedged contract. So that's what Tim was talking about. You really do risk management on ETS2, and it just becomes a commoditized product like any other. So in this case, it would be you as a customer that does the risk management, so as an energy buyer or head of procurement or with your consultant. So you can hedge on ETS2 like you can hedge on ETS1, like you can hedge on a spread. For example, in Spain, you can hedge on a spread TTF MIP gas or like on cross-border capacity booking. So you need to determine based on what your business is and what your energy procurement strategy is, if the best strategy is to have pass-through, fixed, or hedgeable contract. Because again, the real question is, can you pass it through to your end customers if you have any? Taking all of this in consideration, we've mapped a counter proposal on what to do and sort of a roadmap to success, taking in consideration all of the changes with the ETS2. So the first step would be to assess market status where you're active. So are your activities based in a country where ETS2 is not applicable because there's an exemption? Again, for example, Ireland and Finland. Or are you in a market where it is crucial that you prepare because ETS2 will come into force and it's a fully new tax? The second step would be then, as I was describing, to factor ETS2 as a criteria in your tendering process, and to determine what is interesting for you, and if you want fixed, if you can afford to hedge on them, and that will depend on your level of risk aversion. Third step is to check contract clauses. So these are the ones that I was showing, just to make sure that it suits your business and what you're capable of managing. And fourth, active risk management, which goes in the same way. So if you decide to take the hedging route, which is probably the ones that we would recommend the most, then you need to follow prices, regulatory evolutions, and just treat ETS2 like any other product that you are hedging. And finally, and which is not just the final step, but sort of over it's covering really everything, is to plan for ETS2 additional costs in your budget, because this will show up in every invoices and it needs to be taken into account, especially if we have a rising price, for example, if the price stays around where it is now. All of this can be summarized in an active management and a better control over cost, because that's the result that you're looking for. ETS2 still bears a lot of uncertainties, as we've discussed today. However, uncertainties can always be managed a bit better by planning. So by being in control of the cost, it means there's less of a surprise on the bottom line. And I will pass it back to Bart for the proposed mitigation strategy full.
Okay, thanks a lot, Emma. It's good to see indeed that although 2027 is still some time from now, that it's important to take it into account for your tendering, for your contract negotiations, check on ETS2 clauses, and start taking costs into account for your budgeting. Because if you have a look at the chart that you showed, it's a significant share of the cost, I would say. So thanks a lot for that insight on what to do with it in your energy procurement. Um, I think if we take one step back before stepping into some of the questions that were dropped in the chat box, if we take one step back, I think we can put this in the context of a broader carbon strategy, one where you start setting up your carbon reporting. You implement that carbon risk management strategy, as said by Tim. For ETS1, it's a fairly common strategy to really do risk management there. Let's see to what extent and how quick the market develops to start doing something similar for ETS2. And let's make sure that your contract allows for it so that you're prepared to do a risk management strategy there as well. In general, I think it makes sense to do some improvements on lower emission intensity for the products to the extent possible, and looking at the various industries that we have here in Europe. For a lot of them, it's different to look into lower emission intensities for the product, so that might not be the easiest step to take. Move to electrification where possible to avoid, of course, this is something that is being done on natural gas consumption and emissions. So moving to electrification would be some support here, although for others it could mean that you move some volume from ETS2 into ETS1. So that is something to consider for a certain group of industrial customers, I would say. Make a business case for renewable gases where needed. Emma, I saw a question on use of biomethane and biomethane certification under ETS2. So that's maybe one that we can kick off with. And then make a business case for CCU, CCS, or carbon removal. I think in the case of all three, they're still quite expensive at this moment in time. We saw, of course, the Bloomberg forecast, the VAID forecast on ETS2 in euro per ton. So let's see, Tim, if any of those forecasts materialize, and if that would mean that CCU, CCS, or carbon removal comes back into the money. Emma, Tim, I see two questions for you. Tim, one that's partially answered already, so maybe I'll start with Emma first on use of biomethane and biomethane certification, and then Tim, we can move to you. I'm not sure if the answer you provided was to the whole group of participants. If not, you can briefly recap so that other people can see it as well. Emma, I'll give it to you first.
Yeah, so indeed, this is something that we didn't cover fully with the sort of actions to take to plan the impact of ETS2, and biomethane is the question that we now receive increasingly. So one thing that changes is now if you want to purchase biomethane certificates to avoid having to purchase the ETS2 certificates, you have to make the calculation depending on the auction price or the fixed price that is offered in your contract and the cost of biomethane certificates. What changes here, because we see prices varying between, depending on the country, around 10 to 17 or 20 or 25 euro per megawatt hour for biomethane certificates. Again, depends on the quality, and this is something to check, and this is sort of new with ETS2. You have to check the quality, where it comes from exactly, and if it comes with a proof of sustainability. And this is very important because a guarantee of origin without a proof of sustainability cannot be used for ETS2. Biomethane guarantees of origin in general, biogas guarantees of origin have a certain cost. They are much higher than electricity guarantees of origin. So you have to be very careful if you have already targets in your own company to decarbonize your gas consumption and that you've been purchasing biomethane guarantees of origin, just plain nothing special, maybe crop or waste from a nearby country or your own. If you want to continue doing this and that you prefer purchasing the guarantee of origin to cover your whole volume, then you have to make sure that there's a proof of sustainability and that this proof of sustainability guarantees that the quality matches the one of ETS2. So there's a specific list, which also feel free to contact us to have the details of the specific criteria. But this list has to be respected, otherwise it's just an expensive cost that you have to bear and cannot use for ETS2. However, obviously it still fits decarbonization targets within your own company.
Okay, thanks a lot. Tim, on the question of the COT trading overviews?
Yeah, clarify that, but maybe also just to add on that biomethane question. I mean, on ETS1, certain countries like Germany, Belgium, Netherlands, France, if memory serves me right, have the ability that you also use biomethane certificates to reduce your ETS1 exposure. But as Emma alluded to there, the price points don't really work out at the moment. It's sort of where there's a 5-to-1 ratio, if memory serves me right. It's still cheaper to buy EU allowances than it is to buy the biomethane certificates, plus all the additional clarity in terms of showing cross-border flows, showing that proof of sustainability. I think to do it in Germany, you've got to surrender the certificates on one registry, have the right proof of sustainability on another registry, and yeah, it's quite cumbersome. So it'd be interesting to see whether the ETS2 requirements are similarly complex as ETS1, or whether certain member states allow a bit more flexibility on that. But, yeah, so there's a query about the actual makeup of that commitment of traders report. So that line I put in terms of positions of traders was specifically for investment funds. There are separate categories that take out into account commercial undertakings, compliance buying, but the market really focuses on the investor position because they're the non-natural sort of parties in the market. So their holdings are outside the scope of the fundamental demand supply. So the market takes a real interest in what those investor positions are more than anything.
Okay, thanks a lot. I see another question on the introduction of ETS and the impact on CHPs. We will have to be in scope for ETS2 for the gas purchases used to run CHPs, while our CHP emission is in scope 1 of ETS. I think CHP is a bit specific there because that would fall under electricity generation. Electricity generation is scope 1, is ETS1 scope, so they will not do any double taxation there. That's also one of the reasons that derogation options are there for Ireland and for some other countries, is really they want to avoid double taxation, either between national carbon taxes and ETS2 or between ETS1 and ETS2. So for CHPs, they will stay under electricity generation for ETS1. I see another question on common practice. Do you expect to become a common practice for gas suppliers to offer hedging possibilities to the customers under EU ETS2 allowances given the forecast on liquidity? I think liquidity at this moment in time is indeed key. I think maybe you can go a bit deeper on that, what you would offer for ETS2 bidding, or what you would offer to suppliers maybe at a later stage, but liquidity is key. So what we see in the contracting is they say we'll pass through costs, but more and more suppliers start to give the option to say the moment liquidity kicks in, we will negotiate in good faith or sit together or add clauses to try to give you market access to start hedging those ETS2 allowances. And I think that matches a bit with what Emma said on taking control of this aspect of cost. It's a significant aspect of cost, or it's expected to be a significant aspect of cost. Let's make sure that your contract allowances, that your contract is prepared for it. At this moment in time, we don't see it yet as a common practice, but we would expect that once liquidity kicks in, that suppliers will start to see this as a unique selling point versus other suppliers. If you can give this option of route to market, as Tim called it, entry to market versus another supplier, I think that's a good differentiator. And maybe Tim, you might offer it for customers as well.
I mean, just what I was thinking. I mean, it's interesting hearing Emma's sort of structure, and my experience of energy supply contracts is you've got your kind of wholesale market costs for gas or electricity, but then you've got your non-commodity costs as well. And I wonder if this will very much fall in the bracket of non-commodity costs. And typically, suppliers offer the ability to either fix those or have those as floating, i.e., pass through. So, I'd expect probably ETS2 allowances fall into this, but it did make me think, if a end client wants to take responsibility, and we see this in the shipping sector, for example, where ship owners in their charter party agreements, they give the charter party the option to either pay the cost of allowances that the ship owner buys or deliver allowances to their registry account, their MOHAR operator account. And I wonder if that's another option that could come in, that a client could say, do you know what, Mr. Supplier, I'll handle the EUA2 requirements and I'll deliver them to your account. So you just tell me on every supply of gas or whatever it is, fuel, the embedded carbon value of that delivery, and I'll deliver those EUA2 allowances to your account. So again, it really depends how much ownership the end client wants to take off versus asking their supplier to manage that for them.
Okay. I get a reminder that we have run out of time today. I see there are a few questions left unanswered, but as promised in the beginning of the presentation, we'll pick them up via email later on. I would like to thank everyone. I would like to especially thank Tim and Emma for joining us today, and some of the internal colleagues for organizing and all the practical setup, let's say. So I hope it was an insightful presentation. We will share the recording of it afterwards, and wish you a nice remainder of the day. Thanks a lot.
Many thanks.
Thank you. Have a nice day.